Hello. Today is our second class for advanced accounting. We'll still talk about consolidation. In last week's class, we touched a little bit about investing activities, right? We mentioned the company big, company small. When company big acquires shares of company small, not necessarily shares that are publicly available, but shares of small, own some percentage, right? Depending on the purpose of owning the shares, depending on what is company B's plan for those shares. Company big might adopt different methods to account for their stock investment. We talk about equity method, we talk about fair value method, right? Fair value is quite easy to understand. We use market value to every time we use market value to determine what is the worth of what is the value of the investment, and compare to the previous reporting period's number, and then figure out whether companies have gain or losses. Right. One thing we have to understand is that when we so if there's somebody, right, if there's somebody wanting to buy stock just to buy low and sell high, right, what really is matter to this particular investor is that, okay, how much I bought this and how much I can sell this for, right? That's a gain. And a plus, between this period, if the company also issue cash dividend, he's going to be happily to take cash dividend, which becomes part of the gain as well, right? But how much earning this being company small or the investee company announced or made does not matter at all to this personnel, because if the earnings are great, right, those earnings will be translated into high stock prices. So he claim again. If earnings were bad, stock price will decrease. So for this person, he only needs to consider stock price. On the other hand, if we have somebody holding a lot of company small shares, with the company big holds a lot of company small shares, right? In this setting, fair value does not apply, because no matter how the market price changes, right, this company big cannot dispose company small stock at will, because they need to pre-commit which accounting method they're going to use. So in this case, to them, right, with the company big buy a lot of company small share to control, to have significant influence for the strategic purposes, which makes them that they won't sell this investment, right, just because of price. So in this case, the stock price, market price doesn't matter, right? It doesn't matter at all, because they go high, I won't sell. They go low, I won't buy, right? Just that easy, right? So what it matters, right? Because I invest in this company small for strategic purpose, and I want this company to do well. What do we mean by do well? Usually a company does well, they have high stock prices, but we still need to discuss which one matters, right? In this case, I only care about how well they do, right? Accounting wise, performance wise, because accounting measures performance, right? So in this case, if the company made money, the company gets bigger, right? Stock price doesn't matter. I don't depend my decision on stock price, but if company made money, company gets bigger proportionally based on how much company big owns in company small. Company big investment gets bigger, right? When company small, the investee company lose money. Company small gets smaller, and so proportionally, big investment in small gets smaller as well, right? There's another thing is when company small announces cash dividend. What is cash dividend, right? Basically, company small says, okay, look, I'm taking out cash from my bank account, give it to investor. All right, we're going to talk about this concept real soon. Give this to my investor shareholders, right? So this time, shareholders, the company small loses cash, right? It's taken, given to people, but shareholders more like withdraw their deposits, right? The investment gets smaller, but I got a cash in my hand, right? Like you withdraw from bank. You don't feel too bad about withdrawing from bank, although your bank account becomes thinner, but you got more money in your pocket, so you don't have to feel bad. Some people feel bad, but you don't have to. Rational people don't have to, because you're the same, right? As if this never happened. Okay, so today we're gonna expand a little bit. Like the fair value is easy, everybody understand, and that's not a purpose. We are still talking about strategical purchases, but you know, there's a difference, right? So say, for example, there's a, let's give a hypothetical company, right? Let's say HEB, okay? Let's say you own 30% of HEB. Do you think you control HEB? Not necessary, right? What does control mean, right? Well, let me ask you, what does control mean, right? Control means if some person controls the other person, we are saying that this person being controlled. This controlling body can use the other party's belongings as if it were his, right? And meanwhile, he's going to be responsible for the people being controlled, right? That's what we mean by controlling, by control, right? They can demand other side to do whatever they want, right? That's the thing. And so in the company side, it's the same, right? When we say a company controls the other, we are saying that basically company big. Let's say if you say company big controls company small, what we are really saying is a company big can make a company do anything, small do anything they want, and company big can okay, yeah, I'm kind of company big have access to company small's assets as if they were company big's own assets, and the company big will have to be responsible maybe for the liability as well, right? So there's a difference, and usually this difference goes with the shares, right? If you own 30% of somebody, you have significant influence over that personnel, but you don't control him, right? Technically speaking, or in the old world, if you own more than half of a company, then you are controlling it. Today's world, it's not so it's a little bit more complicated, okay? So it's not only looking at the shares. I mean, you might own 30% of a company, right? But if you are also given the title of a chairman of the board of directors, and you were given over half of the chairmanships positions of the chairs of the board, or you have veto right, all these would allow you to control even without owning more than half of the ownership. Okay. So today's world, when we talk about a company big controls company small, we are not only referring to the shares, right? The shares might be smaller than half, but a company big can still own company small via other means. Okay, so keep that in mind. So let's just take a look at an example. We're gonna do this practice, and then later I'm gonna give you some homework. So let's do this first. We're gonna talk about a simple setting. Let's go through the work and the practice, and let me give you some homework. You do it yourself and figure it out. Okay. Like I said, you have to upload it, and the most important is to show me your steps. Let me know you're really thinking. On January 1st, 2014, company big obtained 100% of company small shares by paying 5 million cash and issuing 1 million shares of their own stock with $1 face value per share and the $10 market value per share. Right before the transaction, big and small's financial statements, balance sheets to be exact, are as below. Okay, so if you look at big, they all have cash, AR, inventory, PPE, patents, and the loan, common stock, additional paid-in capital, and the retained earnings. Okay, so for big, we have 6, 3, blah blah blah, and for small we have 2, 5, 2, 2, 2, and we have big book value. BV refers to book value, and MKT and MKV refers to market value. All right, we're going to talk about what's the use of it soon. So 3 questions here. What should big's balance sheet look like right after the transaction? And what should a small's balance sheet look like right after the transaction? Let's solve this first, and then we can discuss the third, consolidation. Let's do some very easy consolidation, okay? So to tackle those issues, right, let's type our first question that we try to answer. Oh, it is the same question, actually. So first, let's look at a big perspective, right? Let's look at just the big, all right? So we know that a company big obtained 5 million, obtained company small, 100% of company small, all of small, by paying 5 million cash, right? From this, we know that this is for big. Let's ignore this for a while. So for companies small, we know that they lost cash, right? They lost cash. They give up cash. How much? This is quite straightforward. And what else did they give up, right? We know that companies big also issued 1,000 shares of their own stock with $1 face value and $10 market value. So here's something tricky, and many people might think I'm not clear, but I think I'm clear enough in real world. So company big issue stock to other folks in exchange for what? In exchange together with the 5 millions, right? And 1 million shares, 5 million, 1 million shares, and 5 million worth of stock, right? Because the 1 million shares, they are marketed, although their par value is $1. You can go to intermediate 2 or 3 to check what is par value. But their par value is $1, which is face value, but their market value is $10, right? Meaning that had company big decided to sell the 1 million shares, you could easily collect $10 million together with the $5 million. They're gonna be paying. They're gonna collect $15 million, and they used all the $15 million for what, right? For what? For the 100%. For the 100% of small. So here we have, right? And also remember, company big issued the stock, right? So it's new stock. If we go back to our intermediate 3, we know when a company issues stock, they have 2 things, right? One, based on the number of shares issued, book value, par value, common stock, right? And between the difference between the market value and the par value goes to additional paid-in capital. So this is what we are doing here. Common stock, additional paid-in capital, difference, right? So company small, big, give up all these for what? For investment in small, right? How much is it again? I don't like it's not aligned well. It was equal to how much company big give up. All right, so 15 million. Before you move on, let me ask you a question. Think about it, right? Think about it. Who receives the $5 million and the shares, right? Who receives? Is it a company small or company small shareholders? Those former shareholders, they give up all their shares to company big, and in exchange for those stuff we just mentioned, right? So from this perspective, the moment they give up, they have nothing to do with company small anymore directly, right? So think about it. Who receives the $5 million and the 1 million shares, right? Is it a company small or company small's former shareholders? There's a difference, and we can think about it, right? So the first question is, what should a BIG's balance sheet look like right after this transaction? So this is what a BIG did, and what we know is, I'll add one more column here, and what we know is cash will be lower. Cash will be lower by, I'll add a post, okay? Cash will be lower by 5 million, right? So this one subtract, oops, sorry. Will be lower by 5 million because they paid. From this transaction, anything affects AR? No. Anything affects inventory? No. Anything affects PPE? Not really. And anything affects patents? No. What else was created? Investing small, right? This is an asset. So investment in small was created from how much? From 0, which is nothing here, increased by 15 million. So we have here, okay? Anything touch loan? Probably not. So we have loan, right? Common stock, it was 1 million, now it's another million. It was 1 million, and now it's another million. And the additional capital, it was 2 million. Now it is 9 million more, so 11 million. And there's nothing touching return earnings, right? So if you think about it, total asset post-transaction is here 33 million, and here we have 33 million. So we are good to go. So this is company BIG's balance sheet right after this transaction. All right. So let me ask you another question. What is company Small's? What happened to company Small? In this transaction, did company Small receive anything? Some people might say yes. Think about it, right? Who receives? Let's say you are the shareholder. You are the shareholder. You used to have 100 shares of Google. Now somebody bought Google shares from you. Are they paying you or are they paying Google? They are paying you, right? Does Google receive a dime from the transaction? Probably not. Can we see what I'm talking about? So in this case, shares are being traded, right? But from the money and the other substance, right? They are coming from BIG's hands. They are coming from BIG's hands into Small's former shareholders' hands in exchange for Small shares, right? Just like you sell your Google shares, Apple shares, whatever shares, Tesla shares for some money, right? The money goes to you. It won't go to Google, it won't go to Apple, or it won't go to Tesla. Remember, there's a difference between the company and the shareholders, individuals. We call legally, let's not go too far, but there's a difference. Can we see that? There's a big difference. So in this case, right, did a Small receive cash? No. AR change? No. PPE, new PPE, sold PPE? No. Patent? Nothing happened. Do they have investment? Not at all, right? So same, they didn't borrow money, they didn't pay off loan. There's nothing changing the common stock. It is still the shares, still the same amount of shares, same amount of additional paid-in capital, same amount of retained earnings. The only difference is what, right? Is the owners change, but it's the same, right? It's the same. The owners change. That's it. Like somebody bought their Google shares, right? Does it affect Google? No. The name is you. The owner becomes that guy instead of you, right? So straightforward as that. Okay. So those two questions we answered, right? This one we have here. This one, let's say NA, no change. What should the consolidated balance sheet look like right after transaction? So, like we said, consolidation is actually not so complicated. If B controls Small, in this case, 100% ownership, right? As somebody who's interested in B, as somebody who has stake in B, naturally, those people would be interested in Small, right? But if we don't do anything, if we just look at a BIG's financial statement, we would see that the investments, the shares of BIG that are in Small is only represented by this small code number, 15 million. So they don't tell anything. However, from our accounting classes, we learned that, for example, here, cash 2 million, inventory 2 million. Although both of them are 2 million, but they mean very differently. So, and also we said when BIG controls Small, BIG have same access to Small's assets as if it were their assets, right? Same for liabilities. So investors, those who have stake, those who are interested in BIG would naturally want to see BIG and Small as a group put together. What do they have, right? So consolidation is to answer this question, providing consolidated financial statements. What, for example, consolidated balance sheet? What is the assets of and the liabilities and equity, BIG and Small, put together? consolidated income statement is what this group makes, right? And a consolidated return earnings statement, return earnings, same reason. So let's take a look, right? So we know that, and another thing is, let me ask you, market value and book value, right? We know big bought small shares, right? So big has to decide how much I pay. So when you go there, decide to buy some stuff, what matters to you? Is it the market price matters or the book value matters? Or what is book value? How much small obtained it for, right? So let's say you thought someone has a piece of, do I have anything worth money here? Probably not, right? I'm just saying, I do. Okay, let me just show you some stuff. I bought for my daughter. Okay, so it's displayed here. So here's a Care Bear that I bought when my second one was born, I think. So it was, and they have some paint on it. So, okay, yeah, I need to clean that up. Anyway, so it was bought for her, right? So today, let's say somebody want to buy it from me. When I bought it, it was like $350, I think. And today, the market price is about 1,000 or 1,200, something like this. So if you really like Care Bear for certain reasons and you want to buy, right? What is in your equation for you to pause a streaming or not, right? You know the market price is about 1,000 bucks. So of course, historical cost, my cost, right? If you want to buy from me, the fact I bought it for 350 doesn't matter. If I ask 600 bucks, you would think it's a steal because compared to market price, it's much cheaper, right? So my point, when it comes to big buys company small shares, the logic is no different. You know, it's the same logic, right? Only market price matters. In company big eyes, when they value everything from same perspective, from their own perspective, right? So in company big eyes, small cash is 2 million, no problem. AR 2 million to 5 million, inventory 2 million, PPE from small's perspective is 2 million, fine, right? But a big thing is only worth 1 million, so big allocates only 1 million to it, right? And investment and a pattern, right? Pattern, small book value 2 million, too big is 4 million. So let's call this 4 million, right? For the new group. Because if we think about consolidation, the group is newly formed. So big's perspective don't change, but this is formed for big, right? This group is formed from big's perspective because those who want to know big, they want to see big and small put together, all right? So they don't need value from small's perspective. They need value from big's perspective from small's assets, right? So here, what it matters are these, all right? Okay, so let's talk about some easy stuff, right? So here we know that a consolidated cash is let's just add everything, okay? Consolidated cash is 3 million. Consolidated accounts receivable is 8 million. Inventory, 7 million, right? PPE is gonna be 6 million and 7 million, sorry. And patent is gonna be 7 million, okay? And somebody might say that, okay, let's add small. Let's add investment. We'll do this. And we know that a loan has so it looks like a fun. So let me ask you this question, right? So we are saying that basically, hey, company big pays everything for small based from their own perspective, right? And let's take a look at this. All right. So The total market value of company Big's asset is how much? 14 million. Okay, and the loan market value of loan of the liabilities is 10 million, which tells us market value wise the net value of small is 4 million, right? However, how much did so if we really look at everything putting together, it's 4 million worth. However, how much did Big pay? Big paid, we know, worth almost 15 million. So they are paying 11 million more. What are they paying, right? We don't know yet. And we have a, what might they be paying? We know first, we know a company has very, very good employees, right? You will pay a lot of money for very, very good employees, and the employees are never accounted on the financial statement. So there might be the company has a super awesome employee team, right? It is there. And other reasons also include, for example, like some political connection, exclusive contracts, all those things cannot be shown. Or for example, or it might be just the CEO of Big, board of Big just becomes too overconfident and they are overtamed because they are not smart enough, right? But at that point of time, we don't know yet, right? We know they paid for something, but those things cannot be identified. We don't know, right? We may think, but we don't know because those things cannot even be reported on financial statements, on balance sheet, right? But we know how much those things worth, and it's 11 million, right? Because they paid. So what we are saying is, and also we have to understand, right? Big and small, do we still report 15 million investment? We are reporting big and small put together now, right? There's no investment. How can you invest in yourself? Big and small, they are together right now, right? So there's no investment in small because big and small together. It's a group, right? Within the group, there's nothing to report, right? So 15 million is gone, but we do know that from Big's perspective, the things not reported on Small's financial statements worth at least is good enough for them to pay 11 million, right? So we call this goodwill because we don't know. We call it goodwill, right? So the total asset here becomes this much, and the total loan is 21 million. And we have common stock, additional pending capital, and the retained earnings same as Big's, right? Why it is same as Big's? It's not as the 1 million, 1 million, 1 million of small here. The reason here is if we take a look at this post, think about if we take a, you can either remember the mechanical or we can think about it because later we will introduce steps, formulas to work on this consolidation. But at this step, I want us to think about it, right? So what we are seeing the post book value, post this transaction, and we know for Big, in addition to all the items, they have an investment account, right? Investment account, which is 15 million already, right? What is this 15 million represents? That this 15 million represent? It represents everything small has minus everything small o, okay? And this is on the asset side, and this is total asset. And the equity of any company equals to total asset minus liabilities here, right? So we can see the equity here equals to total asset of Big, which includes numerical value of all the investments in small, minus loan, which has nothing to do with small. So when we talk about Big's investment, because Big's balance sheet incorporates their investment in small already numerically, right? So Big's equity also contains, equity is a difference between total asset and total liability. Equity also contains numerically the value of equity of small already, which is what we have here, okay? Think about it, all right? So this is a consolidated balance sheet of Big and Small right after this transaction. Okay, so I will, like I said, I will upload homework on Blackboard and give a deadline on Blackboard. Thank you very much.